Hello everyone, welcome back to this channel. This time, I want to show about the situation of Russian economy. As of October 2025, Russia's economy remains under significant pressure, but continues to show resilience in the face of Western sanctions, global market shifts, and the ongoing war in Ukraine. After experiencing strong growth in 2024 due to massive state and military spending, the Russian economy has entered a period of stagnation. Inflation has started to ease, yet overall growth is slowing, and structural weaknesses have become more evident. The government emphasizes fiscal stability and self-reliance, but challenges such as declining consumer demand, labor shortages, and energy sector disruptions are constraining progress. 1. Economic growth and output. The International Monetary Fund, IMF, forecasts Russia's GDP growth at around 0.6% in 2025, a notable slowdown from the 4.3% growth recorded in 2024. This deceleration reflects reduced fiscal stimulus, limited access to foreign investment, and the exhaustion of wartime industrial expansion. Much of the current economic activity remains concentrated in defense and heavy industry, while civilian sectors such as retail, construction, and services struggle to maintain momentum. Analysts describe the situation as a shift from short-term wartime growth to long-term stagnation. 2. Inflation and monetary policy. Inflation, which surged above 10% in previous years, has gradually declined to around 8 to 9% by late 2025. The Central Bank of Russia has maintained tight monetary policy, keeping interest rates high to stabilize prices and the ruble. Although these measures help control inflation, they also limit private borrowing and investment, particularly in small and medium-sized enterprises. The bank aims to bring inflation closer to its 4% target by 2026. 3. Fiscal policy and government spending. The Russian government continues to rely heavily on state and defense spending to sustain economic activity. However, the draft budget for 2026 projects a deficit of about 1.6% of GDP, indicating efforts to reduce dependence on emergency spending. Oil and gas revenues remain a major source of income, but fluctuating energy prices and sanctions on exports have reduced reliability. Despite official claims of economic stability, many analysts note that these fiscal buffers are gradually weakening. 4. External and structural challenges. Western sanctions continue to restrict Russia's access to advanced technology, global financial markets, and foreign investment. To compensate, the country has deepened trade ties with China, India, and other non-Western partners, but these relationships cannot fully replace lost Western markets. Additionally, labor shortages caused partly by mobilization and migration are driving wage inflation and reducing productivity. In 2025, repeated drone attacks on oil refineries have also caused regional fuel shortages, affecting transportation and logistics. 5. Public and private sectors. The Russian economy has become increasingly state-driven, with large public enterprises dominating energy, defense, and manufacturing. Private businesses face bureaucratic constraints, high interest rates, and limited opportunities for innovation. Consumer confidence remains weak, reflecting the broader uncertainty surrounding wages, prices, and future job prospects. 6. Trump's sanctions against Russian oil giants at the end of October 2025. What happened? In late October 2025, U.S. President Donald Trump announced a new round of sanctions targeting Russia's largest state-linked oil companies, mainly Rosneft and Lukoil. The sanctions froze their assets in the United States, banned American companies and banks from doing business with them, and restricted oil trade involving U.S. dollars. The measures were framed as a response to Russia's continued military operations in Ukraine and alleged circumvention of earlier energy export restrictions. Immediate economic impact. The sanctions shook global oil markets for a few days as traders feared reduced Russian supply. Inside Russia, the ruble weakened against major currencies. Fuel prices rose domestically due to disruptions in export logistics. Investor confidence dropped, and energy company shares fell sharply on the Moscow exchange. The Russian government promised support for affected firms, but analysts noted that access to foreign technology, financing, and export markets was further limited. Broader consequences. 1. Revenue loss. Energy exports are Russia's main source of income, over 40% of state budget revenue. Sanctions threaten a sharp drop in foreign exchange inflows. 2. Fiscal strain. With lower oil revenue, the government faces a widening budget deficit, forcing possible tax increases or spending cuts. 3. Energy redirection. Moscow is trying to reroute oil exports to Asia, especially China and India, but faces higher transport costs and discounted prices. 4. Financial isolation. Russian firms lose more access to Western capital markets and banking systems, making refinancing debt much harder. 5. Domestic inflation. Rising fuel and import costs risk fueling inflation, which was already high. Political and strategic effects. The sanctions are seen as part of renewed U.S. pressure on Moscow to weaken its ability to finance the war in Ukraine. Economically, they accelerate Russia's shift eastward, deepening trade with China, India, and Middle Eastern partners. However, long-term growth risks are rising. Experts warn the economy is becoming more closed, less competitive, and more dependent on state control. In summary, Russia's economy in October 2025 is stable but stagnating. The country has avoided economic collapse thanks to strong state control, fiscal buffers, and resilient energy exports. However, growth has slowed sharply. Inflation remains above target, and structural challenges persist. The focus on war-related production sustains short-term stability, but limits long-term development. Unless geopolitical tensions ease and structural reforms occur, Russia is likely to face a prolonged period of low growth, high prices, and limited innovation. Trump's October 2025 sanctions on Russia's oil giants struck at the heart of its economic engine, oil exports. They caused short-term market turmoil, weakened the ruble, and increased fiscal and inflationary pressures. Over the long run, they may push Russia toward deeper economic isolation, slower growth, and heavier reliance on non-Western partners. Thank you for your watching. Please subscribe to get more videos related to political and economics in the world.